Hi, John Riley here from Key Tax Solutions. Just following up on this series of capital gains tax, and today we're going to talk about commercial property. Now, for capital gains tax, commercial property, the capital gain works exactly the same as a residential property, the same basis, purchase price, selling price, ignoring associated costs in this example, gives you the capital gain of 400, and you get a 50% discount, excluding companies and self-managed super funds, reduce the gain to 200, and you pay it on that. However, there's a however. If you own a business and you actually own the property you run the business for, there's potential massive capital gains tax exemptions. So think if it's a rental property that you're going to buy, why not buy one for your actual business? So you still get the 50% reduction. However, there are other tests you can pass for small business capital gains tax exemptions. There is 4 tests there. There's the active asset test, which gives you a further 50% reduction, making your gain 25%. We have what they call a retirement exemption. There's various tests you need to pass for that, but it gives you the ability to reduce your actual gain to nil. 15-year exemption, again, if you've owned the property for more than 15 years or you've used it majority of the time in the 15-year period, you can also reduce that to nil, and there's a rollover for a deferral for 2 years, which means you could use that money to actually buy a further capital gains. Now, these exemptions are very complicated and they need to be investigated in much more detail. However, just be aware of them when you look at buying an investment and buy an investment for your company.